Welcome back. The house is now looking full. We have Anuj back with us. Anuj, I can't believe how much I miss you. Okay, tell us, what do you have for us for the day?
You know, Lara, 2 weeks back, I was highlighting the fact that the FIs are at record shorts and retail is at record long. And normally retail wins this battle 3 times it's won, and now it's 4th time it's done that. So this morning, actually, I don't like this stat that FIs are now at 59% long versus 13% at start of October. More shorts in the system means bigger the rally. More longs in the system means the market's vulnerable to any kind of accident. And we are sitting on 1,000-point rally in October already. And there's, of course, as I said, retail has trumped over FIs for 4th time. There's this RBI meet after FOMC. So I think there's a lot of events lined up over the next few days. The US midterm election on November 8, I think, is going to be very important. You've already seen a bit of a pre-election play in that. So my sense is that if you're a Nifty trader, you've had a big rally. Now the risk reward perhaps is not in your favor. You want to just perhaps stay on the sideline for a bit. If you're an aggressive trader, maybe even explore just for the near term a short trade with 17,850 a stop. I mean, that may work given that SGX Nifty for last 2 or 3 days has been trapping, everyone. Completely illogical moves happening over there. I think a sharp dip, if you get somewhere around 17,500, that's the base now for the market. That's where your risk reward will once again become favorable. And on the Bank Nifty, by the way, that's been the market leading index, but it's facing congestion around its all-time high. It's just about 400, 500 points off its all-time high. Most bank numbers have beaten the estimates quite handsomely, so that's something which might help. And the bigger move though may happen post MPC, because you would still want to see what the MPC is saying and then perhaps make a move over there. And just one last point, I think Uday Kotak had also tweeted, I think the market, especially in the US, has become very vulnerable to all these accidents. Meta fell 25% yesterday, and these kind of moves sometimes make you a bit cautious just about the near-term moves.
Okay, I take your point, Anuj, about the fact that there is an FOMC meeting. It could indicate something about their December thinking, and you have the midterm, post-midterm election behavior in the US. But one thing I can assure you, the November 3rd meeting is a non-event. It's only a report to RBI. We shouldn't angst. I mean, that's one angst less, but I take on board the other concerns.
And the other point, Anuj, that Anuj made with regard to the FIs being net long, even data suggests when they're net short, it's better. Wherever they have been aggressively net short, we have had a great series. Just take a look at that. Some of the data points should come up for you. They were net short in October. They were aggressively net short in July. And then we had great series as well out there. So let's see how this one pans out. For the time being, though, they are net long by a margin in comparison to the other series. Well, Gurmeet, before we let you go, wanted to just ask you about the auto space. Today we have Maruti that will be coming out with a set of numbers. Sonia will be in focus in the second half. What's your view out there? I think you have had a preference for Mahindra over the other auto names. What's your stance now?
Continue to like M&M. If you see, while we get carried away by the recent performance, but if you see last 5 years, it's moved up from, let's say, 700 to 1300, right, which is like 14%. Still trades reasonably at about 17-18 times. I think it's getting its product portfolio back on SUVs. I think they will gain market share there. Very good response. The month-on-month production is improving, which is reducing the order book. Cancellation rates aren't too high, which is basis our dealer checks. And great capital allocation. I think if you see the business, it is 60% automotives and 35-36% is tractors. So I think overall, I expect some bit of margin improvement and maybe also tractors to do better in the second half. And there's that great focus on, ROC and capital allocation, which I think is hardening. And Maruti, I would like to watch out, maybe a few months more in terms of how they are getting the response to the new launches they have done, which includes Grand Vitara and Brezza. They're trying to get some market share back. I've also seen some, rise in average selling price also. That could, and one concern for Maruti has been its margin coming down to low single digit from 17-18% 4 or 5 years back. If they can improve that sequentially, and they're going aggressive on hybrid now, it might be worth looking at some point of time, but want to probably see it more for a quarter or two. And a lot of work happening on premiumization also in various models.
Oh, absolutely. And there's a slew of new launches from Maruti stable for all you auto enthusiasts, right? There are 6 Maruti cars in the next 1 year itself. There's the Jimny, the Baleno SUV, the Wagoner Electric, the Swift 2023. So there's lots to pick from. Of course, we'll watch out for the numbers. Gurmeet, just stay on. I wanted your thoughts on MAPMA India, because we have the management joining us. Now, just for the benefit of our viewers, right, this is a company that listed in December of 2021. It listed at about 1581 rupees and it went all the way to 1900. But since then, since the listing price, the stock is now down almost 15% at about 1350 or so. The revenues this quarter came in at an all-time high. The company's G Trophy business looks solid with the revenues doubling on a sequential basis. But it's the margins where we have seen a contraction this time to 41% versus 47% last year. Rohan Verma, the CEO and Executive Director at Mappa India, joins us now to talk about that. Rohan, that seems to be the problem, right, on the operational front. And I guess that's what's reflecting in the stock as well. Your margins now 41%, profits have not grown compared to same time last year. Do you anticipate more operational pressure? And what could the triggers be for the second half of the year?
Good morning, Sonia. Thanks for having me on your show. Actually, if you look at our business, it's in a very good situation. Revenues have been growing 35%. This G2P business has, doubled its revenue sequentially. Now, there are some dynamics at play, which we kind of explained even last quarter. We are making basically three investments. One is in scaling up the G2P business, which is an IoT device-led business. In this, your initially a margin when the device is sold is lower, but then you start getting the higher SaaS margin, subscription margin in the subsequent years. So as that business grows, there'll be an impact on the margin, but the overall absolute contribution will start growing. The other two investments that we are doing is in the brand building and awareness for MapMyIndia and Mappls, because one of the things that will drive future growth for the company is more and more people knowing about MapMyIndia and Mappls, both the platform, which is for B2B and B2B2C, but also the consumer side. And lastly, we are kicking off a lot of investments in the new product development, which is keeping us ahead of any new competition, whether it's in drones, whether it's in real view 360-degree or metaverse maps, or even our software for digital transformation or our NK suite and our APIs. So we basically are able to keep our EBITDAs and PAT in a particular range where we feel comfortable. We've talked about 35 to 45% EBITDA and 30 to 35% PAT. So what you are seeing on a year-to-date basis is actually pretty healthy.
So
Rohan, that still doesn't answer Sonia's question. Your revenues are growing very well, 41% for the half year. But that's not reflecting at the EBITDA profit level. That is growing slower than the revenue. So the worry about margins persists.
Lata, again, I'll repeat it. When the G2P IoT business grows fast, your initial margins will be under pressure, but the subsequent year margins will come up. Coupled with investments in marketing and product development, this will affect EBITDA margin. But if you look at it, 60 crore EBITDA in the first half, 50 crore PAT in the first half on a base of 140 crore revenue, which is 40% up. On a year-on-year basis for first half. We're pretty happy with where we are.
Yes, you've given us a margin band, but can you just tell us these investments that you're making, right, in marketing, in product development, in Mappls brand building? What is the average investment this quarter, in the quarter to come, compared to, say, what it was about 2 quarters ago? And what is the kind of expenses that you're sort of allocating which could impact your margins in the second half?
Correct. So if you look at our expenses in this quarter, and we've broken it up to show kind of what the difference is between marketing and other expenses, etc. You'll see an upwards of 5 crore, 3-4 crore change in the marketing expenses on a quarter basis. That is one. And on the PAT side, at least I can say that the other income and the effective other income is lower compared to the previous year. Same time, and effective tax rate is higher. So that's the dynamics playing with PAT, at least in this quarter.
Okay, all right. Hi, Rohan. I was looking at your organic growth actually. Though the headline number looks very good, the organic growth, it appears it's around 18 to 19%. So that's a little bit slower. But be that as it may, what do you end this year with in terms of a revenue number, point number one? And also give us a number. What is your open order book as of the half year mark?
Nigel, important thing to understand is the IoT business that MapMyIndia had before.
Yes.
plus adding Gtropy as a acquisition at end of this past year, so just 6 months or so ago, we've combined the two IoT revenues. So apple to apple, actually, the organic growth is actually slightly higher than what you said. We don't give specific guidance for revenue on a forward basis, and also the open order book is something that we talk about on an annual basis because order books are lumpy. But you should be able to get a particular trajectory by looking at our half-year performance. And I can also say on the order wins, qualitatively and quantitatively, the momentum is looking quite strong with order wins across the segment.
Rohan, so second half of the year will be as good as the first half?
That's what we are gunning for sure.
Got it.
But Rohan, what is the opportunity size of this Gtropy and other products that you're launching? Are you the only one in the field? And by when will the revenues start looking, the EBITDA start looking better? As you say, this is CapEx heavy, it's front loaded. But when will it, start paying off? So two questions there.
Yeah, Lata, great question. See, the opportunity size is multi-billion dollars. That's why investing in scale-up is attractive to us. There are 28 crore plus vehicles on the road which can benefit from GPS-based digitization, because logistics efficiency has to be created. You have the Gati Shakti and National Logistics Policy coming in from the Government of India. We are part of the Unified Logistics Interface Platform. So, we are at the heart of what can drive logistics efficiency through technology. And that's where we see this very, very big opportunity. If you just multiply that by a couple thousand rupees, on average of sales revenue, really you're looking at a multi-billion dollar opportunity. And we are best positioned with the best product, with a unique map, plus the IoT solution to take advantage of this large opportunity for Gtropy.
Okay, one area in which you have made an investment is auto startups. You recently invested in a startup called Navgati as well. Now, these take time, right? There's a lot of cash burn as well in startups. So the concern is that perhaps you'd use a part of your cash. You have about 400 crore cash on your books, and to incubate startups. And that may be another drain for you on your profitability. Any thoughts here? And are you looking at that as one of the avenues of investment as well?
Yeah, see, cash in terms of Q2, we've grown from 390 odd crores in end of Q1 to 430 crores cash and cash equivalents in end of Q2. So I think cash position puts us in a position where we should make some investments which can drive future growth. Navgati is a very small investment, and we have roughly 3% in the company. We have put in 1 crore. It's not a large number from the investment point of view, and the real advantage to that is oil and gas as a vertical. We can go deeper together with them, which is their SaaS vertical SaaS focus. The other investment that we've made is in Kogo, which actually is quite interesting. It opens up a travel commerce market opportunity for us, where they are a gamified social travel commerce platform. Think of Instagram plus for travel, focused on commerce with a community and loyalty angle. This is very interesting to our automotive OEMs who are trying to drive loyalty and consumer engagement through the tech in the car and the companion app, and they're all about travel. Plus, this opens up a consumer opportunity for us in future. Again, that's also very large addressable market. So MapMyIndia is on a very strong foundation in terms of maps and tech. We are trying to open up addressable markets for us in the future that can position us very strongly in the medium term. I think our organic profitability, which is in that 40% EBITDA range, 30% PAT range, is supporting the fact that we should make investments when we see very large technology addressable markets ahead for us.
Got it, Rohan. Unfortunately, out of time. Thank you very much, and all the very best for 2023. Gurmeet, a quick word if you're tracking the stock.
So it's a very niche play, Lata, and they're into this digital mapping and geospatial software and location-based Internet of Things, right? And if you compare global, no listed play in India. And also globally, not many companies are profitable, although Trimble and Google are not the right comparison. But if you compare the peers aren't. So it's a business which you have to continuously keep on disrupting, as Rohan was pointing out too. And, while I track it, and we used to also deal with them in my Citibank days and commercial banking side, but these niche businesses kind of environment we are in, the scope for error at these valuations is very low.
Okay.
All right. Well, Gurmeet, we just have about, I think, 2 minutes left for the markets to open. So thanks a lot for joining in, and have a great weekend. That's the word coming in from Complete Circle Consultants. By the way, the pre-opening rates have settled absolutely quiet. Maruti is topping the charts. Good numbers expected this quarter, so up about 0.5% there. Reliance is the other one, up almost about 0.5%. ITC is also gaining ground. And in the broader markets, something like a Tata Chemicals, of course, post its numbers, will be reacting. But Mitesh, tell us what's the big call at 9:10?
I'll go with the buy on Dixon Tech. Keep a stop below 43.50 here. Look for a short-term trading target of 45.20.
Okay, thanks, Mitesh. Just stay on because the markets should open anytime now. You were rattling off what's been gaining rupee and bond. If you are a rupee bull or a bond bull, today you're a very happy person. Opened strongly, the rupee at 82.32. Yesterday was, I think, 82.49 or thereabouts when it closed. And bond yields also have fallen a good 3-4 basis points, clearly telling you that the market does not believe that anything adverse will happen on November 3rd. It is going to be a routine meeting. But on the stock markets itself, I think there are very good result reactions, good rise in Gokuldas. There is a bit of a negativity in SBI cap.
SBI.
So I think the markets will chime to numbers to the second quarter results when it opens. And as you said, on the index level, it's a bit of a flat opening. Let's see how we go from here. Okay, just about 3 seconds to go. So you take over, Sonia.
Just, that's the market opening for you, right? Absolutely quiet. So the Nifty is very, very flat, up just about 17 odd points. The mid-cap index is trending in the green. The good part is, after the last hour bump up that we got yesterday, there's a bit of follow-on buying that you're seeing. Now the Nifty is building on to its gains. 17,770 is what we're looking at. Remember, 17,800 is a bit of a resistance for the market. Do they take it out? Does the Nifty take it out? Time will tell. The Bank Nifty for now is just a bit sluggish. In terms of big gainers, it's autos. Maruti ahead of its numbers is up about 0.5%. Hero MotoCorp is up 0.7%. Tata Motors Bajaj Auto also in the green. L&T is the other one that's charging ahead, up 0.6%. Bharti Airtel hit a record high yesterday, so there's some follow-on buying this morning as well. And Adani Ports, Asian Paints, Coal India, a couple of others that are batting for the bulls this morning. On the downside, Sun Pharma is coming in for a bit of profit-taking. A couple of other names in the tech space, Wipro, Infosys, TCS. In fact, yesterday was also a weak day for tech. TCS, HCL Tech, Wipro and Infi are all in the red right now, so keep that on your radar. And JSW Steel, Hindalco, that had a good run yesterday, are coming in for a bit of profit-taking right now. But otherwise, it's a decent opening, you'd have to say. After that last hour rally yesterday, the market is building on to its gain. 17,790 now on the Nifty and a good 200 points higher on the Sensex. Not a bad start at all.
Well, that's right, Sonia. Not a bad start. A couple of earnings reactions. Those stocks that are getting hit hard. SBI Cards, that's down close to around 4.5%. Tata Chemicals, clearly the street has taken note of the margin miss. The top line growth is quite good, but because of the margin miss, the stock is down close to around 4% or thereabouts. RBL Bank yesterday had a big run out there. There were various rumors in the market. There were a couple of clarifications that we put out as well on the screen. The stock is down close to around 3%. Well, on the gaining side, Tata Motors DVR, that's really catching your attention. In this week, it's up 20%. While the Tata Motors stock is up still in single digits. So that's telling the street believes something's got to give out here. I'm not sure what it is, but that's gained big time in this week itself. A few more stocks that we should be looking at. Infibeam is up close to around 12.5% odd. It's only a 17 rupee stock now, but that one as well has moved up. And Gokuldas, well, that's opened up well in the green, up close to around 4%. Management is quite optimistic about the prospects from here on, and it seems the street likes that. Tata.
Yeah, I think the market is punishing numbers that have not come up to their expectations. So SBI Cards is taking it on the chin, as is Tata Chemicals. I mean, it was only a margin miss. Otherwise, the numbers were, not much to complain about.
Also a lot, I guess. So maybe some profit.
Yeah, maybe profit. Yeah, it's always a sell on news likelihood. But that's a solid 4% off Tata Chemicals and 5% off on SBI Cards. So clearly, the revolving credit falling is not impressing the market, as Abhishek was pointing out. Indus Towers also is not getting any leg up. Again, the numbers did show some kind of problems, and not getting the money in time from one of its vendors. I would assume it's Vodafone. That is also impacting the performance of Indus Towers. But basically today metals are not doing all that well. I mean, NMDC, SAIL, Nalco, Vedanta, all of them, Tata Steel, anything metal is not doing well.
After the big
There
run
is that.
yesterday.
Yes, so there is a bit of profit taking there.
Okay, well, for the market, the mid-cap index is now a tad bit in the red, down about 50 odd points. Prashant Khemka, the founder at White Oak Capital Management, is joining in now to give us his view on the markets. Prashant, good morning and happy Diwali to you and your entire team at White Oak. This has been a bumper Diwali, is it not? I mean, no one really expected that the market will zoom like this despite all the challenges that we've seen globally. But how are you feeling right now? Do you think new highs will be taken before we know it, or are you still a bit circumspect?
Thank you, Sonia, for having me on the show here, and wishing you also a very happy Diwali, and your colleagues also very happy Diwali at CNBC.
Thank you.
So the market is obviously there's confluence of factors that are affecting the market. Global factors have been very dominating this year, particularly due to the sustained higher level of inflation, which has caused on one side, central bankers to hike rates around the world, and B, also caused some slowdown in consumption and worries about slowdown in corporate profits going forward. So as a combination, if you see, the markets in India have been flattish because the issues have not impacted, this time around, issues have not impacted India as acutely. Because inflation in India at about 7-8%, it's not outside the range of what we are used to. We had CPI in double digits during the early part of last decade sustained for several years, and our average over the last 20 years itself has been about 5%. So 7-8% is not that far off from what is our norm. Whereas in the US and Europe, 7-8% inflation compared to 1 or 2% inflation that they're used to, or even lower, is quite dramatic. So for that reason, while obviously it's not a positive, but it's not as acute a problem so far in India for a variety of reasons. That is so because of the consumption basket and whatnot. And secondly, the problems that Europe is facing because of the war also has not been such a negative for India and Indian corporate sector as well. There are several segments of the market or sectors or industries that are in fact benefiting on top of the China plus one trend that's been going on since very long. I think with what's happening in Europe now, India is expected to play even more important role in supply chains going forward as an alternative source and being viewed as a safe haven, not only from an equity markets perspective or capital markets perspective, but also in the real world or the corporate world for sourcing and for having a manufacturing base. And that is overall contributing to the positive outlook for the Indian industry.
Yes, you put your finger on it, Prashant. Actually, I think the Hong Kong index is at 2004 levels, somebody is pointing out. So, I mean, yes, it is very cheap, but who is to say it won't get cheaper from what you're saying? Prashant, I will come back to the global backdrop in just a bit. I wanted to get your view on the results season so far. Are you getting a sense that results are likely to buck the global slowdown trend and continue to do well, or should we be prepared for some earnings downgrades?
So a very interesting point, first of all, Lata, that you mentioned about Hong Kong being back to where it was some 20 years ago, and happy to come back to that later.
Please.
But to your more specifically your question on the results, see, we are not obviously completely insulated from the rest of the world. But what we are seeing in India compared to, say, more generally, because every country globally also, it's not that just India has done well. There are other countries also like Indonesia, Brazil, and others who have done well this year. But if I were to talk about India compared to, let's say, emerging markets in general or global in general, in India, there are some positive factors also at play. or the combination, there are always negative factors and positive factors. And yes, there are negative factors right now at play, but in India, on balance, there are a few more positive factors at play. So if China, because of couple of reasons, more than a couple of reasons, a strict COVID policy, but even otherwise, what's happening politically over there and all the attention it has gained around the world, a combination of those factors on top of what was already going on, which is a desire from on part of global corporates to diversify their supply chains from China. So China is negatively hit because of all the factors that are going on globally, plus this additional factor. Whereas India, while it is negatively hit by what's going on globally with respect to inflation and interest rates, is a recipient, a positively impacted by this particular aspect of shift away from China and Europe, as I said. So because of these countervailing factors there is a greater degree of positivity, and that is going to show up in corporate earnings as well. It's not that Indian corporate earnings are not going to be affected at all, and won't get, the growth would be impacted, but it's not going to be impacted as much as, let's say, Taiwan or Korea or the rest of Asia, the 75% of emerging markets, where a slowdown in US and Europe and global markets may impact a large proportion of their economy in a negative manner without necessarily offsetting positives. Whereas in India, there are enough offsetting or mitigating, I would say, mitigating factors as well that should result in Indian earnings performance holding up better than rest of the emerging markets, rest of the world.
Good morning, Mr. Khemka. Thanks so much for joining in. Mr. Khemka, you have mentioned as well in our past interactions that private sector banks, that's something that you like, and that's really been the street as well has been fairly optimistic on that front. But the outperforming index or the outperforming banking names have all been PSUs. And we get management after management who's joining in. They're talking about low credit costs. They're talking about better loan growth. And they're saying that the loan book is in far better shape, just to pour some cold water on those nightmares that we saw a few years ago when the book used to go bad. Do you believe that that valuation argument is good enough to allocate some money to PSU banking names, or would you stick to the big private banks itself?
Certainly. So generally, you're right, Nigel. We have always had, our team has always found a lot of very attractive opportunities in banking, particularly the private sector financials. This year, again, you're right, the government sector PSU banks have done quite a lot better, and maybe even over the last couple of years, they've done quite well. It is, in our view, impossible to keep switching between such large segments of the market, say private sector versus public sector and so on. So the over longer time period, if you see 10, 20-year time periods, private sector has continued to gain market share. They've had much better performance in terms of credit quality as well as asset growth. So growth as well as profitability has been far superior. Not to generalize, because there have been blow-ups in private sector as well, but there are opportunities in private sector banks which have delivered extremely well and do hold the promise of going forward also delivering very well. The governance in private sector financials also in India is very good, or there are at least a lot of opportunities available for very good governance. Now, always in a cycle, there would come times when these government sector banks would, from a low point, do very well. And some of them are good from a structural perspective as well. I don't argue, but it's just that the private sector financials offer a lot more compelling opportunities, even if there are a few in the government sector banks that also have done well over time.
Okay, well, just want to point out there's a big crack that we're seeing in some of these platform companies, particularly on Nykaa. Nykaa is down almost 6% right now on big volumes. It's gone well below that 1,000 rupee mark. Just pull up the stock. As we know, the lock-in period for many of these companies are all set to expire soon. That's on November 10th for the pre-IPO investors. Apart from that, for Nykaa particularly as well, the CTO has resigned. So there's an additional negative news flow over there. But do keep an eye out on all of these platform companies. Many of them are sitting at fresh lows. I mean, PB Fintech as well is now at a fresh 52-week low. It's already down about 60% this year.
But, you know, this lock-in going away is a well-telescoped event.
Yes.
So a one-day reaction looks a little exaggerated. It could also be the contagion from the US. Tech stocks are not the flavor of the morning. Everybody exaggerated the long term from these tech stocks, and perhaps now there is a profit-taking wave hitting them as well. But as you point out in Nykaa, there is a specific reason.
There is a specific reason.
Maybe you want to get Prashant in on that.
Yes, in fact, I wanted to ask him, you know, Prashant, how do you approach this entire space? Because there were big bang listings and there were a lot of, you know, large optimistic projections. But these platform companies have only disappointed investors. What do you do here? Do you stay away entirely, or do you try and look for some opportunities?
So more the latter, Sonia. Always, I mean, we don't usually, stay away from entire baskets of stocks or segments of companies, but do look for individual specific opportunities. As Lata pointed out, partly it's also the contagion from Nasdaq, and it's not just this week or yesterday, but also this year. As you know, Nasdaq is down about a third, right? This year, about 30% compared to Dow Jones, that's down only 10%. So particularly tech stocks have gone out of favor, which is quite a 180-degree turn from last year. If you recollect, Sonia, I don't know how many investors in general would have been calling CNBC lines asking about how they can invest in FANG stocks, right? And today, FANG is completely out of favor. Yeah, last year it was a darling. So the pendulum in companies, particularly in market segments like this, where the most of the cash flows are very long dated, long duration. Yeah, some of them are even concept stocks. When these are long dated business models, the pendulum can swing farther away from the center on either side. Now, and we won't know how far, whether we are even, which side of the center we are. We won't even know. Only in hindsight we would know. So last year, I think pendulum swung with the benefit of hindsight on one extreme, and it could be that we are at the other side of the center already, but very hard to say. There are some obviously technical factors as well right now at play with all the lock-ins that are expiring. So anyone who wants to buy would not be keen to step in and buy today, and would rather wait for the lock-ins to expire, or a lot of people would wait for the lock-ins to expire. So right now they are in a bit of a difficult spot for a combination of factors, Sonia and Lata.
Prashant, let me end with an unfair question to you. But people want to, get that kind of confidence from experts like you. What kind of one-year gains can we look at? We are just about 4% off all-time highs. So all-time highs round the corner. What's the one-year gain?
Absolutely. No, very reasonable question. We get that all the time from clients. And though it is difficult to answer, it is, there's an expected return. Lata, as does our team, believes that markets on balance are fairly valued at this time, and not all times we usually maintain that outlook at a market-wide level. So it's only reasonable. If you look at over very prolonged period of time in almost any country, leave aside some specific starting point to specific ending point, markets in US, Europe, or elsewhere, including in India, have tended to returns in line with nominal GDP growth, plus call it percentage points of dividend. So my general expectation over any forward-looking 12-month period is the longer term, not necessarily just next year's nominal GDP growth, but the longer term is about low double digits would be my expectation, Lata.
Okay, that's a very fair and encouraging reply. Thank you very much, Prashant Khemka. Have a great Samvat 2017 and yourself and your team.
Likewise, you as well and your team. Thank you, Lata. And thank you so much.
Thank you.
With that, let's get to the managements who have announced numbers. Torrent Pharma is on our radar. The company posted a slightly disappointing set of Q2 numbers with revenue and EBITDA marginally below the CNBC-TV18 polls, and additional costs linked to the Curatio acquisition weighing on profit. The company, however, says they're confident of outpacing industry growth by about 3 to 4 percentage points in India and Brazil, and they also see mid to high single-digit growth in Germany. even as US is likely to remain subdued, they said in their press release. Sudhir Menon, Executive Director and CFO at Torrent Pharma, joins us. Sudhir, good morning. Thank you very much. We have some idea of what you are expecting in terms of growth in India and Brazil, where you have given a very clear guidance. What is this predicated on? Why are you confident that you will be able to outpace by a good 3 to 4 percentage points the market growth?
Yeah, so I think the most important factor for us to give guidance on a double-digit growth as far as our branded business is concerned is, of course, the market performance, right?
Okay.
So basically, as far as India is concerned, if you look, the market seems to be stabilizing at double-digit. So July was around 14%, August was around 12%, and September, I think, was around 13%. And I think the market should sustain at low double-digit growth from here. So for us, historically, we have been growing minimum 200 basis points higher than the market, as we are over-indexed on certain high-growth segments. In all our focus therapies, we have been outperforming the markets. I think last 1 year, we have been increasing our field force, and which should help us in getting incremental growth from here on. Second, our focus on new product introductions have played out quite well over the last 24 to 36 months. And all the relevant size new product introduction which we've had in the last 24 to 36 months, we are in the top 3. So the contribution from new product in the overall growth has inched up higher, I would say. Add that Curatio portfolio, which is in a covered market, which is growing 1.6x of the overall market. On an overall basis, it should help us to register incremental growth as far as India is concerned. From a Brazil perspective, again, I think the market is growing at low double digit, and we have been outperforming the market again by 200 to 300 basis points. What has played out for us over the last 12 months is there's good amount of new product launches which have happened in Brazil, and most of them are doing quite well, I would say. Add to that, over the next 2 to 3 years, we feel that good amount of new product launches which will come in, reasonable size launches, I would say. And on the top of it, we have a 10% share of the generic portfolio in Germany, where the scale-up is happening very fast, I would say. So I think on an overall basis, both India and Brazil are looking quite good to deliver a double-digit growth.
Okay. Double-digit growth for the India plus Brazil business together, right? Is what you're talking about, Sudhir?
Yes.
Yeah, individually, both should grow at double-digit.
All right. Individually, both should grow double-digit. Got that. I think the pain point is the US business, right? Because there are 2 warning letters there. There is pricing pressure as well. Do you think it could get worse before it gets better?
No, so I think the pricing pressure is continuing in the legacy portfolio in the US, right? And US is obviously the largest market, and it's not very easy to ignore this market. And given the challenges which the industry has been facing, it's very important to find good spaces which helps you to navigate through this challenging path. So while there are steps which we have taken in terms of our R&D efforts, focusing more on complex product, but I think at this point, what is more important for us is to see the facilities getting cleared at the earliest. So Indrad facility got inspected. We've responded to the US FDA, and I think we should hear from them very soon. The Dahej inspection is still pending, I would say. But based on the favorable outcome, I think over a period of 6 to 9 months, the new product approvals should start flowing in. And surely, I think once the new product approval starts flowing in, it should add positively to the overall revenue and profits of the company. But there's a waiting time at this point, I would say.
No, but the warning letters were issued in 2019 no, for Indrad and Buddy. You will have any clarity on whether it's a 2022 resolution, 2023, earlier, later half?
Yeah, you're right. I mean, it's not Buddy actually, it's Indrad and Dahej.
Yeah.
Okay, okay.
You're right. Indrad got a warning letter in 2019 and Dahej got a OAI in 2019. And I think there was a good amount of delay which happened because of the COVID happening, right? And I think the inspection started in 2022, early 2022. And as I said, Indrad is already inspected. And we should hear from the US FDA in 90 days' time. And that's the scheduled time when the US FDA comes back to you. Dahej, as I said, the inspection is still to happen, but we expect the inspection to happen anytime soon.
Okay, all right. Hi, Mr. Menon. I had a couple of points then with regard to what you have just said. One is, what about margins? You have been in that vicinity of around 29.5 to around 30%. Do you hold on to that? Point number one. And the US business, you gave us a fair bit of color. But do you think on a quarterly run rate, you can do better than this $37 million that you delivered in the last quarter? Will things look up from here on is what we're trying to understand.
Yeah, sure. So I think quarter one this year, we registered an operating EBITDA of 29.2. And quarter two, we registered operating EBITDA of 29.4%. I think the way I look at least this level should be sustainable both for quarter three and quarter four. Although there are certain cost impacts which are yet to normalize, I would say, and if that's normalizing over the next 2 quarters, the margin should inch up a little higher, I would say. From next year, I think we should expect a minimum 75 basis improvement in the margins. That's something which I can say. Coming to your point on US, actually, so I think all depends upon when we get a clearance of this facility, right? I mean, as far as the pending new product approvals are concerned, the timing of the approval is very important in terms of finding out what economic value it can bring to you, right? But given the uncertainty at this point, it's very difficult to assign any value. So I would say worst, at least for the next 6 to 9 months, the existing run rate of 32, 33 should sustain.
Okay.
Any brand acquisition on your shortlist? Something we should hear soon?
No, so we just completed Curashio acquisition, right? So we are more focused on our integration efforts of Curashio with our existing business over the next 6 months, I would say.
Fair.
So currently nothing much to talk on any other potential deal.
Okay. I just had one more question on the US business, right? Given all the challenges that you spoke about, you said that the margin should be sustainable overall in Q3 and Q4. But on the sales run rate, you did about $38 million in Q2. What do you think the average could be for the second half of the year?
Should be around the same number, I would say. Around 35 is the number which I can guide.
Okay. All right, we'll leave it at that. Sudhir Menon, pleasure speaking with you. Thank you very much for joining us. Have a great 2023.
Thank you.
Okay, we have to take a break now, and thereafter, Snehal Shah of Century Textiles and Industries will join in to talk to us about their second quarter earnings. We will also connect with Arvind Kumar of Chennai Petroleum thereafter to discuss their second quarter numbers.